Hello, good evening, and a very warm welcome to the next session of the Powerhouse Series BFSI. I hope all of you are doing well today. Please type in the chat box how are you feeling today and how was your day at the bank. I'm assuming most of you are from BFSI, so how was your day at the bank? Or if there is a member who wants to talk about the interbank rate, what was the interbank rate that we experienced for USD today? Karamatli, good. That's great. Someone is having. Yes, good. What about others? Not too bad. Mohammed Fawad Khan. A lot of people from the banking industry, but nobody's talking about the interbank rate. It is that a bit. Does anybody know what is the rate that the USD closed on today in interbank? Around 232 jars. Thank you. So let's just kick off things. The today's topic would be efficient market hypothesis. We have a new trainer with us, that is Mr. Raid Nazir Ahmed. Some of you might know about him. He has a good experience teaching ACCA students in the past for multiple exams. I would like to invite Raid Saab to jump in and take over the session and formally introduce himself and tell us about his experience and then kick off the session. Over to you, Raid Saab.
Thank you very much, Mr. Feroz. I'm grateful to you and ACC for giving the opportunity, and a very warm welcome to all of you, all the audience over there. I hope you all are fine and doing good. So let me start with my presentation straight away. So today's session is about a very popular hypothesis known as efficient market hypothesis, which relates to financial markets. So in today's session, we will be discussing about the main financial markets existent in the world, the instruments traded in that, and when we talk about efficiency, what does exactly efficiency means? How is a market efficient or inefficient? Then we'll be going for insights on efficient market hypothesis. Then who are the main participants in the financial markets? How is the pricing determined? What factors are taken into account? And then we'll be having a brief introduction about the analytical features like fundamental and technical. To start with, I would like to give a brief introduction about myself. My name is Raid Nazir Ahmed, and it is approximately 22 years now I am trading in financial markets, and approximately I have traded in all sort of financial markets in these 22 years. And apart from that, I have been actively teaching ACC students for subjects of managerial finance, financial management, advanced financial management, taxation. I I enjoyed a lot of fame in taxation and financial management subjects. From year 2000 to 2019, I have been actively engaged in teaching ACCA. Apart from ACCA, there are also other curriculums which I have been teaching, including the curriculums of CPA, CMA, and MBAs. And comfortably, I have more than 17,000 students to my credit, which I have taught over the period of 19 long years. I have some publications also to my credit. Okay, so let's start with the financial market. Number one point is, what do we exactly mean by financial market? So financial market is basically a marketplace where financial instruments are sold and bought by different participants. The main financial markets include stock exchange, the most popular one. I'm sure everyone knows about that. Then it is the foreign exchange market, in short form known as FOREX. And then we have the commodity market. The commodity market, we'll be discussing what instruments are traded in the commodity markets also. And then recently, in recent years, in a decade or so, one more financial market has emerged, which is known as crypto exchange market, that is about cryptocurrencies. So these are the main financial markets, and basically these all are exchanges in which you exchange money for shares, money for cash, currency for another currency, or any commodity for cash. So these are exchange markets, and popularly known as financial markets. So these financial markets exist so that they can facilitate all the participants who want to purchase or sell the instruments they hold. There are many functions of financial markets. I have just listed down a few of them. The first function is the price determination. It is because of these financial markets that an instrument, or in other words, asset, is being priced. So for example, if we say in Pakistan, for example, what is the share price of PSO, Pakistan State Oil? So how will we determine it? So it will be determined by the Pakistan Stock Exchange. Similarly, if we want to know what is the price per share of Tesla, an American company, so we'll see the New York Stock Exchange to determine its price. So it is the financial markets because of which the prices are determined for these assets. Second function is capital formation. So capital formation is about how the money is raised from the capital market. So for example, a new listed company comes into trading. So it needs a big amount of money. In today's world, we need millions and billions of amount to run a successful company. So this amount is gathered from the stock exchange. So it is about capital formation as well. Then there are so many participants in these markets. We'll be discussing that in a while. So to be efficient, the financial markets, to be efficient, it is important that the transaction cost should be minimum. Now, I would like to just get you familiarized with the transaction cost. Any financial instrument you buy or sell, whether those are shares, those are any metals, for example, gold, silvers, anything, those are cryptocurrencies, those are USD dollars, you want to buy British pounds, anything, you need to buy them through financial markets through some broker, and brokers obviously charges some fee, popularly known as commissions. So it is very important for a financial market to work efficiently that the transaction costs are not so much that discourages trading in it. So the commissions should be very low. Next function is easy access. In today's world, perhaps accessing financial market is absolutely easy. Location doesn't matter. You need an application of that broker or brokerage house, through which you can access the markets and buy and sell commodities or stocks, anything. So easy access is also a function. Risk sharing, not necessarily that the company has to take all the risk of the capital. There are investors, including investors like you and me, retail investors, institutional investors. They all put their money inside and share the risk of the company. And obviously, needless to say, the returns are associated with risk. There are no returns without taking any risk. So risk and return are associated. But we'll discuss this risk factor in some other session, that's technical analysis. Liquidity. So I have, for example, the shares of PSO, for example. How easily I can sell them? Can I sell them in a matter of minutes, or in a matter of hours, or in a matter of seconds? The early you can sell your asset, it means that your asset is more liquid. So these financial markets provide high level of liquidity where you can, with few exceptions, in most cases, you can sell your assets in a matter of seconds or minutes. So financial markets, before going into depth, to make sure that everyone is familiar that what assets are being traded in the financial assets, I'll be just discussing them in brief. So first point we would like to discuss is the financial instruments traded in stock market. Stock market is a very popular word among our community, at least. So stock markets, basically the shares are traded in stock markets, also popularly known as stocks. So it is basically the equity market. But the debt instruments issued by companies or government, in few cases, that for example, government issues treasury bills, those are also traded on stock market. Companies issues debt instruments like debentures, those are also traded in the financial stock market. So shares and debt securities, these are two popular instruments that are traded in stock market. In most of the stock markets, derivatives are also offered. So derivatives like options, futures, swaps. These are not very popular in Pakistan Stock Exchange, but derivatives is something traded in a very big size in other stock markets like New York stock market, London stock market, Tokyo stock market. And then lastly, we have mutual funds. Mutual funds, as most of you might be familiar, these are institutions or funding organizations which take funds from different investors, pool them, make a portfolio, and invest them in a diversified manner in different sort of instruments. So stock market deals with all these four things, but most traded among these are the shares of companies. Forex simply means currency exchange. So name any currency of the world, all are traded in the forex. The popular one are the US dollars, Japanese pound, British pound, Japanese yen, euros, to name a few. And here also derivatives are traded as well. So if you are trading currency, for example, today's rate, for example, is 232 rupees per dollar, and if you transact rupees for dollars, so you are selling rupees to buy dollars, then we will be terming it as spot forex, that you are trading on spot. You're trading currency for currency. But there are derivatives as well. There are currency options, currency futures, and ETFs. So, but today's subject is not about the derivatives, it is about the functioning of the financial markets. So this is only to give you a brief idea that what assets or instruments are traded in these markets. The third most popular is commodities. So the main commodities traded, or the popular commodities traded, are metals, precious metals like gold, silver, Agriculture produces like wheat, oil, coffee beans, grains. Then we have some other metals like copper, zinc, aluminum, and energies like natural gas, crude oil, finance oil. These are all traded in the commodity market. But the difference basically is that the commodities are mainly traded on future contracts. For example, if I want to invest in commodity market and I want to buy crude oil, let's say I assume that the crude oil prices are going to rise. So that is not a possibility that I buy a crude oil. For example, I buy 1 gallon of, sorry, 10 gallons of crude oil and just try to find some place to store it. So that doesn't happen. So most of the commodities traded in financial markets are future contracts. Future contracts means that you have the right of physical possession of that particular asset, but you have time till maturity. So for example, I take a 9 months future of crude oil. So till 9 months, always sell my futures without taking the physical delivery. In case the 9 months expire, then I will be obliged to take the physical delivery as well. So commodity markets, in short, are mainly based on derivatives rather than spot. So these are the three markets. Just a brief reminder before going forward. Stock market mainly trades shares, but also some derivatives and debt instruments are traded. Forex, basically currencies are traded, spot currencies are also traded, and derivatives are also traded. And commodities includes metals, energy, agricultural produce. A long list of commodities are traded in the commodities market. And these three are very, very huge market. At the end of this today's session, I will also be discussing that what are the size of these markets and how much volume is traded in these markets. So in today's session, where we will discuss, we are supposed to discuss the efficient market hypothesis. So the number one point we would like to discuss is what is efficient market. So we have already discussed what are markets. Now we want to discuss what is meant by being an efficient market. A market where there are large number of rational profit maximizers. So the definition goes like this: large number of rational profit maximizers. So for example, stock market. If a country has a stock market in which a very few hundred people trade, that won't be considered as an efficient market. To be an efficient market, the number of traders, here known as profit maximizers, should be large in number. So for example, in most of the countries, these are trading on stock markets, thousands and thousands, in some cases it goes to millions of traders are trading at one time. But to be efficient, it is important that all the investors are rational. Now this is a problem. Now here rational means that, for example, if I speak in this way, rational means that everyone knows what you all know, like being an ACCA member or student or something like that, being a part of accountancy profession. There are most of the information you know which other people don't know. Like for example, you might have studied interest rate parity, purchasing rate parity, dividend growths, price earnings. These all things is important to be known by all the traders existent in the market. That means they are rational, they know everything what they are doing. If that is the case, then we will say that the market is efficient. So it should have rational participants, and all participants are there for profit maximization. Actively competing here means some is buying and some is selling. So I am here to sell my PSO shares, and someone among you are here to buy the PSO shares. So we are competing with each other. Whereas I and you, all of us, are just trying to make profits, in fact, maximize our profits. So you are here to make profit, I'm here to make profit, but the transaction is opposite. We are competing with each other. Someone is selling while someone is buying. For example, I am selling and you are buying. So it's an exchange. With each trying to predict future market values. I am selling the PSO shares because I believe that the price of PSO shares has already reached to a higher level and it will fall. Let's say it's my analysis. So I predict the future market values in this sense. So I want to sell my PSO shares now. Whereas on the other hand, your analysis says something else. Your analysis says that the PSO shares, despite being on the higher side, it still has a room to go even further. So you want to buy the PSO shares at this price in anticipation that it will further rise in price and you will be able to make profit as well. And to be efficient, the next definition is the information required is freely available to all. So you and I can always access the information about relevant information about the PSO, for example, who is the chief executive officer of PSO at this moment, who are the directors, what are their competencies, what projects are the PSO is launching, how much political influence it has, what was the recent earning per share, what was the dividends it announced previously. In this era of rising crude oil prices, how is PSO dealing with it? Is it making more profits or is it struggling for profits in this quarter, for example? So this all information should be freely available, that is easily available to everyone. If that is the case, we are just assuming that if that is the case, we would say that the market is efficient. But these assumptions are not that solid. It can be challenged. For example, the first challenge I would like to portray is really all the traders are rational. Means I doubt that everyone trading in the Pakistan Stock Exchange knows about the dividend growth, knows about the earning per share, knows about what the global economic environment is going around, what was the P ratio, why has the market crashed, what is the political scenario of the country. Does Is everyone rational? So I'm not sure that everyone from over here is from Pakistan or not, but assuming most of you are from Pakistan, so I would like to pose here a question. We all belong to an ACC community, that is accountancy profession, and we have come here after a number of years of education, and most of us must be experienced as well, and we see the world in a certain perspective, assuming that we all are rational. Now on the investing on the stock market, I want to know what is the political stability of this country and what is the rational approach. Is a rational approach means that the one political party should be the most rational option for the upcoming elections, or it should be something else, another political party? I have just symboled it, the ones in Pakistan. I'm sure you know what I'm talking about. So ask yourself, is this political party more suitable for the economic conditions, or this other political party is more suitable? What is rational? Now here comes the problem. The definition of rational and the perception of rational varies with perception, and it is a matter of debate. So everyone cannot think alike, everyone cannot analyze alike, everyone has his own parameters of analysis, and that is why the efficiency in the market is not at its maximum. So there is not the financial markets is not an ideal market. It has many flaws, that is, in other words, it has many inefficiencies as well. So a large number of traders all rational, able to predict the prices, and the information is freely available. Going further into definition, the efficiency can be characterized into, can be broken down to three things. Now, to make the things easy for this session, when I talk about market, just consider stock market for easy example. So for stock market, for example, three characteristics has to be seen to decide whether the stock market is efficient or not. Number one, operational efficiency means the transaction cost should be as low as possible so that the trading should occur quickly. So I want to sell my PSO shares. The commission the broker would charge should not be discouraging. It should be as low as possible. If the commission is high, then I'll be reluctant to sell my shares and I would like to hold my shares further for a long period of time before I can make even more profits to make up the cost of the commissions. So that should not be the case. So it should be as low as possible so that the participants can sell and buy the asset frequently without considering the commission cost, because it should be as low as possible. Pricing efficiency, that is again the same thing we discussed in the previous slide. Prices of the capital market security fully and fairly reflect all information concerning past events and all events that the market expects to occur in the future. So prices reflect all the information available in the past as well as in future. For example, uh, about dividends, what the company offered dividends in the previous year, financial year, in the further previous year. For example, what was the dividends in 2019, 2020, 2021? These are past events. And what the company is going to declare dividends in upcoming period, that is in 2022, that is, we are also able to predict the future as well. So if that is the case, we would say that it is a pricing efficiency. And allocative efficiency is all people are rational. All people have a rational approach to invest their funds. If that is the case, then it means that the funds would be allocated to most profitable companies. So if you and I am both are going to the stock market, we will be seeing the financial data of each company in detail to decide which company is better for investment. So you and I both picked up, for example, OGDC because it was more profitable. So we decide that our funds should be allocated to these companies, should be invested in these companies. So the more the company is profitable, the more the people would like to invest in that. If that is the case, we would say that the market is efficient. So these were the basic characteristics of an efficient market. Before we go further, one brief common sense based point. What causes the stock price, that is share price, to change? Why a share price increase or decrease? Why is it so that the PSO share, for example, is 565 rupees per share in one day, and after 3 days it drops to 540 rupees per share? Why is the share price decreasing or increasing? So the answer is that as new information is available, as soon as new information is available, the rational investors decide accordingly that what would be the movement of the asset, and accordingly they decide to buy or sell a particular instrument. For example, suddenly we come to know that there has been some political instability in the country. A news just broke up. Suddenly you will find that the stock market shares will react negatively. And if you find that, for example, Pakistan, being a high debt economy, finds further new debt from the IMF, a news which is expected to boost the economy, as soon as the news is news emerges, you will find that the share prices reflect this information and the prices increase. So as new information is available, if the information is optimistic, the stock prices will rise higher. And in case the information is negative, you should expect that the prices will go lower. This is not only true for the share prices, it is true for each and every instrument traded in all the financial markets, whether it is about gold, it is about, for example, gas prices, oil prices, shares we have already discussed, currencies. For example, as we speak of today, uh, the Great Britain pound has nearly touched its parity. I remember my whole life that the British pound was significantly more valued than the US dollar, but that wasn't the case in this week. This week witnessed that the British pound and US dollar at one point of time just were at parity, that was almost equal with very insignificant difference. So this is how the things react. The ongoing factor, which is known as fundamental factor for this crisis, is the gas crisis in the Europe, triggered due to the war between Russia and Ukraine. And these are the fundamental negative news because of which the prices of British pound is suffering, and the inflation is uh, multi-decades high in UK at the moment, in UK and all Europe, in fact. So these all information reflect not only in share prices, but all the instruments in all the financial markets. So these all need to be considered. So these were about the market efficiencies. Now let's discuss our subject, the efficient market hypothesis. So the efficient market hypothesis states that the prices of any securities always fully reflect all relevant information about the security. Now, that keywords in definition is always, fully, and information. That the information is available always people consider it, and people always take the decision to buy or sell accordingly. That is, the prices fully reflect the information available. If that is the case, then the markets are really efficient. But now the next question is the two important questions from here. What is all available information means? What does all information mean? And what does it mean to reflect all information? So to go into precise detail, all information according to efficient market hypothesis, our today's session's topic, all information here means past prices. You are able to see what were the past prices of that particular asset. For example, what was the price of a particular share in last Christmas, so that you can able to predict that what could be the price in the coming Christmas as well. What was the price when general elections were held in, for example, Britain lastly? Did the price of British pound fell, or did it rise? So you must know the knowledge of the past price. If you know the price, what happened in the previous general elections, you can forecast that in the upcoming elections what could be the prices accordingly. So the past prices are very important to predict the future prices. So those of you who know about something about statistics, so we are talking about interpolation and extrapolation. So from the past price movements, that is, we interpolate it, we then forecast, that is extrapolated, for the future prices. So the past prices information should be available. I'll be coming that on this point again. Then the other information is all public information is also available and the prices reflect that. The financial instruments reflect these all things. Public information means all the information available in press, that is any media. So all information is available and everyone considers that information in its rational manner. And number three, all information including inside information as well. For example, this is just an example that I am working in a company. Just to explain the point, I'm just assuming that I work as an accountant in PSO. So the point is, what is happening in PSO, perhaps I know that very well. The public doesn't know that, but I, being the bookkeeper, maintaining the records, know very well what is the situation of the company and whether in this year the company will be able to declare dividends more than previous year or less than previous year. So this is a very important information known as inside information. If that information is also available, that should be also taken into consideration. So these are the all information available. Okay, so when we say all information in efficient market hypothesis, it means all these three informations. Past prices, public information means everything which is in media, in press, and even that information which is not publicly available but known to few people as an inside information, that is also taken into account before deciding whether an instrument should be bought or sold by a rational investor. Now, to what extent these things are available? To make the point, past prices. Now the past prices, I mean, how much past prices? Past prices of 1 year or 5 years, 10 years, 20 years, 30 years, 40 years, 50 years. What past prices? How much time period? Now that is the point. For example, there's a stock market, for example, New York stock market, and you can have the past price movements of previous 30 years, 3 decades, compared to Pakistan, for example, where you can have past prices of 20 years. In that case, we would say that the New York stock market is more efficient compared to Pakistan because more past prices information is available. So the point here I'm trying to make is that the extent to which the information is available, that decides how efficient a market could be. And in the efficient market hypothesis, in this hypothesis, three sort three categories of efficiencies are identified. Either a financial market is a weak form of efficiency, or it is a semi-strong form of efficiency, or the extreme case it is strong form of efficiency. So the efficient market hypothesis describes that a financial market could be either weak form, semi-strong form, or strong form, depending on these three informations we have just discussed. The extent of availability will decide. Now, to get an insight about it, how to differentiate. So for weak form, I will be using W as a symbol to explain. For semi-strong form, I would say SS, and for strong form, I would say S. So past price movements are very important. If this is the only thing available for decision making in a financial market, we would say that it is a weak form of efficiency. So this is available for weak form of efficiency. But if there is a market in which past price movements are also considered in addition to all public information, means both of these are available, then it would be semi-strong form. So the point is, if both of these things are being used to take decisions by the investors, then it is semi-strong form. And if only past price movements are considered, then it is a weak form of efficiency. So in a question answer session, I would be asking, I would like to hear from you, just to put a question towards yourself. What do you consider about Pakistan? In Pakistan, the people would be considering the past prices, seeing some charts, what happened, what was the price earlier previous year, what is the prices here, and where the prices direction could go from here afterwards. Is this the only thing the Pakistani investors look at, or the Pakistani investors are very rational and they read newspapers, they read financial magazines, they read the relevant vlogs, they watch BBC, they watch CNN, they watch Business Recorder, they watch CNBC, they know what is happening in the Russian-Ukraine war. They are not only concerned about the political parties in Pakistan only, they are looking at the global perspective, and within the global perspective, they are looking at the Pakistani perspective, the climate change, the and everything. Are these all factors being considered? If yes, then Pakistani market is a semi-strong form of efficiency. But if that is not the case, people over here are not that much literate or that much rational, and they do not bother much about what is coming in the press, because they believe that the press is not giving the real information. For example, the people think that the people in Pakistan do not present their information in a true manner. They pass on false statements, they give illusions, there are fraudulent activities involved. If that is the case, they do not trust the news available and they only consider the past price, then it is a weak form of efficiency. So I would definitely like to hear from you. What do you assume that Pakistani, according to your assumption, is a weak form of efficiency, presumably, or you think it's a semi-strong form? I'll like to hear you in the question answer session. And the last thing is strong form of efficiency. Strong form means not only price movements, not only public information, but in fact insider information known to specialists, consultants, people working in the organization, the people who have the confidential information, not exactly that sort of confidential, means they know about the day-to-day affairs of the company, and they know some information through which profits can be made in the financial markets. If that is also considered in addition to these two, then it's a strong form of efficiency. So strong form of efficiency considers all the three, whereas weak form considers only past price movement, and semi-strong form considers past price movements and public information. So before going forward, the research suggests that all the financial markets we have just discussed uh, in the start of this session, all are either weak form of efficiency and semi-strong form of efficiency. None is yet researched as a strong form of efficiency. This is too much idealistic, and there is no research evidence available that there is any market in the world which exhibits strong form of efficiency. So this is purely theoretical. Research suggests that this is idealistic condition which does not exist. However, there are markets in the world which exhibit semi-strong form, and there are many markets in the world with most displaying as weak form of efficiency. Now, what implication does this have to a participant in the financial markets? For example, what implication do you and I have, for example, or what implication does it has to a company whose shares are afloat in the stock market? What difference does it make? So to make a point, just consider an example. Let's say the price of a share was this one, I would just give an example. For example, it was rupees 100. This is just an example. The prices were at the rupees 100 before the news released publicly. The news was about the dividend release. So the market was awaiting how much dividend will the company announce. The announcement can be at any moment. And the company made an announcement in which the rational point is, say the company gave a dividend which was more than previous year. There was a dividend growth. As a result, the share prices should have increased, and the rational approach should have been that the prices should have gone to 110, for example, because it was an optimistic news. The dividends, the share prices went on, it was an ex dividend price. As soon as the 10 rupees per share dividend was announced, the share prices should have moved to 110. If the market is efficient market, this would be the case. This sharp line, the prices was exactly 100. As soon as the market news was released, the prices should be 110 sharp. But that could only happen if the market is efficient, means it is a strong form of efficiency, which I just informed you that there is no such thing apart from this hypothesis which suggests that any market in the world is exactly strong form. That is not the case. So there is either weak form or either there is semi-strong form, which means there is a room for arbitrage. So what will happen is the prices are 100, we all know. The prices is 110, we all can calculate in a matter of minutes as soon as the news is informed. The market would not react this manner because it is not a strong form. There will be arbitrage. As soon as the price is announced, the dividends are announced, the market might overreact, means the prices increase to, for example, 120. It is overpriced. Whereas it should have been 110. If that is the case, the arbitrage is possible. It is 120, it will go over the period of time to 110, and profits can be made in this period. And similarly, the prices, as soon as the dividend was informed, the market did not react like that. Market underreacted. For example, the market price only rose to 102, but it is going to go to 110 because 10 rupees dividend was announced. So here the market price just rose to 102, the market underreacted, whereas it is going to go to 110. So there is a room to make profits over the period of time, because in short term, medium term to long term, the prices is in fact going to reach 110. So this is where profits can be made. So because of overreaction of the market or underreaction of the market, the par value of an asset is over or understated. And here is where the arbitrage, that is profit making, is possible. And this is the opportunities which most of the traders hunt over the period of time, including me myself over 22 years. So this is how it works. Hope you all are having a good insight and something you're learning alongside. I'll be coming to question and answer session once the main contents of the presentation is over. And I would love to hear from you any points you have in your mind. Now, the information, since the new information arrives unpredictably, that is in a random fashion. For example, uh, suddenly a government makes an announcement. No one knew that the government is going to make an announcement today, or a political opposition party just makes an announcement out of nowhere. There was no gathering. Suddenly a press conference was made and an important political move is about to be made. This happened so randomly, so unpredictably, that the market would take some time to react. Maybe it can react, overreact, or maybe it can underreact. But the point here is that the information often arrives unpredictably. Not all information, few information arrives unexpectedly. Therefore, the stock market prices also move unpredictably. So because of this thing, the stocks prices are unpredictable. Any time, any minute of the day, the market can crash. This word, hopefully you have listened already. The market crashes unpredictably. No one was predicting that the market could crash today, but suddenly the market crashed because the information which no one knew suddenly came into news, and the market reacted, perhaps overreacted. So if this is the case, if this happens in the market, which we all know that this in fact happens, then it is not an efficient market. It would be termed as an inefficient market. And the research shows that the stock market, forex market, commodity markets, all these markets do exhibit this random walk. This is known as random walk. So I'll come to this afterwards, but before this, I would like to discuss this share. So this is how the market moves. So weak form of efficiency means that the market is very unpredictable. Like you see over here, that the prices increases, decreases, increases, decreases. Obviously, every day there is not a news. Every minute there is not a news. But the pieces of news of different various perspectives keep on coming. Sometimes, for example, in Pakistan, suddenly a news comes about Saudi Arabia, a news comes about China, sometimes news comes about Qatar, then it's about the UK, then it's about one political party, it's about second political party, it's about establishment, it's about some important legal proceedings, it's about America, anything. The price, the information just keeps on coming every minute. So the market exhibits this sort of pattern. And if you see this sort of pattern, you will just see that yes, the prices are rising, but it's not a smooth run, it's not a linear fashion. This is known as random walk. So random walk is just opposite of efficient market hypothesis. One school of thought, a very popular one, is efficient market hypothesis, about which we have discussed and we are discussing further. And the challenger is random walk theory. Random walk theory is that this all we are discussing means nothing. There is no such thing that the all people are rational, all information is taken into consideration. There is no such thing. And the prices just move randomly and unpredictably. Because if it could have been predicted, people could have made a huge amount of fortune out of nothing. So the theory which challenges efficient market hypothesis is that there is no efficiency. It is always a weak form, and the prices always change randomly and are always unpredictable. So I was just in my today session, in my trading, I was just seeing the US index, just to give you an insight. The US index has gone 2 decades high. This US dollar is all-time high. So it's not only about Pakistan that the US dollar prices are increasing. It is all currencies against US dollars which are struggling. There is no exception actually. Every currency is struggling because it is 2 decades high at the moment. This is the dollar index. Now, these are the past price movements. These are the analysis. These are the patterns which you can see on the screen, hopefully. And this is what random walk theory suggests, that what is happening all the time. This is 1 hourly price movements. So what is happening all the time? Has sudden an important information released, or it is just going random walk? So all the debate is about these two. One school of thought, which is our sessions topic, efficient market hypothesis, one school of thought, and the other school of thought is the random walk. That is, there is no theory, it is just a random walk, there is no theory among this. These are two opposite theoretical point of views. However, the random walk theory confirms the weak form of efficiency, that there is no form of efficiency, market just reacts in this random fashion, if we assume that this is true. So weak form of efficiency, to summarize before we move ahead, the weak form of efficient market hypothesis says that the past price movements can be used to predict future prices. You see what happened previously, you can forecast what will happen next. Prices move random. If prices are moving random, then it cannot be used to predict the future prices. So some information, yes, are used to predict future prices, and some information is random, therefore the movement will also be random and the prices cannot be predicted. So information arrives randomly, so prices changes randomly. So this is the whole idea about the weak form, and at least these two school of thoughts, random walk theory and weak form of efficiency, at least agree on this one point, that is the markets are weak form of efficiency. They both agree on it. Whereas efficient market hypothesis suggest, and the research, there are also some research evidence available, that there are few markets which are semi-strong form. Now strong form, semi-strong form, just for a recall, semi-strong form says that the price fully reflects all publicly available information and the expectation about the future. Now for example, when the war started between the Ukraine and Russia, all analytics were suggesting one thing, that Russia, Ukraine, and European countries will be victimized because of this event. They will be the sufferers. Whereas the other countries will also struggle, in fact. But the main beneficiary of this war, according to 99.99% analytics, was that US will be the most beneficiary out of this event. Now it was not like a rocket science, it was very straightforward. So what happened next was that all the currencies against US dollars struggled, whether it was British pound, whether it was euros, whether it was Pakistani rupees, name any. Dollar rose and all the currencies had to weaken. That is what happened. So yes, there is evidence that the information is available, the information available publicly. It was a public information that the war has started. So the expectation of the future can be predicted, and the prices can be predicted, that which way it will move. But in my example, I just quoted an example of currencies, but the stocks also move in the very same way. As soon as the war started, it was almost inevitable that the stock markets around the world would not crash, which means that it would crash. It was just as if written in the wall. Now, if you see today, any stock market is not performing well, whether it is of Pakistan, India, Britain, New York, Tokyo, just find any. All stock markets are just in recession. So this is how it moves. Currencies direction was quite imminent, known what will happen, and similarly the stocks, accordingly the direction was quite predictable. So if you agree what I'm saying, then that would mean that yes, the markets exhibit semi-strong form. So if semi-strong form is correct, then it means that the fundamental analysis, the news which I have just shared with you, Russia's war on Ukraine, is a fundamental news. Dividend announced is a fundamental news. These fundamental news does make an impact, and if that is the case, we would term that this financial market is a semi-strong form. It exhibits semi-strong form. For example, if it's a semi-strong form, the share should have uh, moved in this fashion. For example, the share price was here, and the news came that the dividends has decreased compared to previous year. So the market should have straight away, without any noise, without going up and down, should straight away go downwards. The price should reach here. If that is the case, the market is semi-strong form, and vice versa. The prices were here, the dividends was announced, dividend was increased, and the prices without any noise, that is without any jerks, taking any jerks, straight away went to its value, intrinsic value, where it should have been. If that is the case, if market exhibits this sort of things, then it means that it is a semi-strong form of efficiency. And now to conclude about the research suggests that most of the markets, especially stock markets around the world, are weak form of efficiency, but some stock markets do exhibit semi-strong form as well, which includes New York Stock Exchange, Tokyo Stock Exchange, London Stock Exchange, to name the main one. But which question I was asking you a while ago, let me answer myself. Unfortunately, Pakistan exhibits a weak form of efficiency because people over here are not that much literate. The investors in stock market are not that much literate, which can analyze in rational manner that an incident, how would this impact the economy, how would this impact. So people are not, do not have that ability. So not surprising that it's a random walk. So nothing special happens in the economy, and you just start listening to the news. The stock market is going upwards, upward, breaking new records, whereas the economy is not doing something special, but the stock market is performing exceptionally well. And similarly, the economy has not collapsed actually, but you find that suddenly the stock market crashes and keeps on crashing for a month or so. That is because the investors are not rational. They take irrational decisions, random based decisions on random information available. So that is weak form. And to conclude, strong form means that every information existing in this world which can directly or indirectly affect the instrument, it is taken into account. So prices reflect all information available, whether it is public or not. But research suggests that markets, in fact, are not of this sort in any sense. There is no research evidence that any market in the world exhibits this form. So this is outrightly rejected according to research. But yes, in the efficient market hypothesis, at least for the theoretical sake, uh, this form of efficiency exists, theoretically speaking, not practically. Practically, there are only two forms: weak form, that is random walk, or semi-strong form. Exhibition is also there in the in the financial markets. So next sessions, I will be summarizing what we have all discussed before taking your questions. So next sessions with me, scheduled on 4th October and perhaps on 8th October. I hope you will join me, and I'll give you real insights according to my 22 years of real world experience on stock markets, forex, commodities, cryptos, and etc. and that would be very giving you a lot of insight. In fact, uh, just check the dates with the ACCA. I can remember it's 4th October if I'm not wrong. We'll be discussing that the information available, past price information,
Right.
fundamental
Sir,
news. Yes.
sorry to interrupt you. The dates are 3rd and 5th October.
Thank you for correcting me. It's 3rd and 5th October. So 3rd and 5th October, same time, it would be two different sessions on fundamental analysis and technical analysis. I hope you'll join me then, and it will give you a real practical insight. So today it was more like theoretical. On those days, it will be more like eye opener with the realistic, real case studies, real insights. Uh, Fundamentals, well, when we will be discussing in the next session, fundamentals are about all about news. For example, if it's about companies, the company analysis, that is ratio analysis, liquidities, profitabilities, dividends, and etc., its future prospects, economic conditions, political conditions, and global conditions. Technical analysis is about charting the prices, a very interesting topic. We'll be going insights about that. These are the two things that investors take into account before deciding whether they would like to invest or not in that particular instrument. So for example, I was just showing you this. If I would not have been taking this session at the very right moment, I was just in a hunt to take a trade over here. This is a single platform. The other platform is not immediately available so that I can give you an view. However, let me explain you. This US dollar index is at this very right moment when I'm talking to you. This is live. You can see that the prices have just broken down. According to technical analysis, which I'll be discussing in the next session, it is termed as break, which means that the prices from here onward would be going downwards. And if you just want to have an insight, I would suggest that now from here the prediction according to technical analysis would mean that the prices hereafter would reach here. So the dollar index is 114 at the moment, 114.06. It should reach here, that is 113.100 approximately. So this is a trading moment which I would have in fact traded if I was not taking this session. So I'll try to show you now the chart just I showed you before. Now I'll show you that without seeing the chart, I can tell you that at this very right moment, the euro is on the rise. And in fact, I'm taking session, I'm just seeing it along with you. So you can see now, because the dollar is decreasing at the very right moment, the euro is increasing. And if I can, to give you a point, I will show you British pound. The same would be the case over there. British pound would be increasing at this very right moment. So you can see it is on the rise, right? So this is how the information is considered. So information considered is about past price movements, how the dollar index moves, how would the euro react, how would the currency react, how would the stock market react, what information should be taken into account, and similar things, and more to come. For example, I would now this is a new site which I use for myself, and I was telling you that not all the information is random. For example, these are the events which happened today. These all are happening at the today, and this is to come in a little while. Tomorrow, what is going to happen? The news is already uh, known that at which time this news will release, and when these news will release, the market will react accordingly, according to the information released. These are the fundamental news, and if the market reacts according to these news, then it is a semi-strong form. And if the market does not consider these all things and just moves in a random fashion, then we would say that the market is a weak form of efficiency. So to summarize all what we have discussed in a quick manner, efficient market hypothesis says that the prices reflect all information. But if the market is weak form, then the information is useless. Because the information will arrive randomly, the prices will move randomly. But if the prices are semi-strong form, then yes, the analysis does matter, but the information more importantly used would be technical analysis, that is charting analysis, where the prices are going as compared to fundamental analysis. These all things does not only have implications for people like you and me, that is investors. These have implications for me and you. It also have implications for companies whose shares are afloat, and companies always struggle to capitalize, to increase their market capitalization. They want their share prices to increase so that the wealth of the company can increase, their credit ratings can increase. To make sure that there is no fraudulent activity or there is no concealment of information, false information is not given, only true and fair information is available. So there are a lot of regulations governed by the government for these financial markets. Three main types of financial markets. This is summary before taking your question: stock market, commodities market, forex market. We have discussed this. I'm just going to give you a brief overview. Stock market is a market where shares and debentures, etc., are traded. Commodity markets are where commodities like agriculture produce, metals, energy are traded. Forex is where currencies are traded, conventional currencies, that is currencies of these countries, as well as cryptos are traded. These are known as forex market. The participants, the participants buying and selling actively in these markets, who are those? Companies themselves buy shares and sell shares. They hold their treasury stocks. Government, obviously speaking, government has to borrow. For example, government has to stabilize the US dollar in Pakistan. So what government has to do is the Central Bank of Pakistan, that is State Bank of Pakistan, will release its reserves, US dollar reserves, in the market to increase the supply. That it will sell the dollars to the market, and when the dollar rate is low, the government, that is central bank, according to government instructions, will buy the dollars from the market. So government itself sells and buys currencies and even some stocks as well. For example, some nationalized companies like let's say PTCL and PIN, etc. Banks have their special department for this. Finance houses, brokers, remember, no instruments can be bought or sold without brokers. So brokerage houses, those are active participants. Fund managers, institutional investors like insurance companies, they are very heavily involved in that. Retail investors are very important participants, people like you and me. So these are the main participants in all markets, whether it's forex, commodities, for example, government. Okay, Pakistani government may be an exception, poor, weak government, financially speaking. But like, for example, if you see the news, you will find that China almost every year buys gold from the market to increase its bullion reserves. And at the point we speak, there are three main countries who have the most gold in their central bank for reserves, which are United States of America, second is China, and third is India. So they purchase commodities. Similarly, all the governments have to buy crude oils, And crude oil, remember, crude oil is not something which can be kept in a room or a warehouse. It is not a commodity of that sort. So all the governments, to ensure their price stability of the oil, deal in future contracts of the oils, that is commodity markets. So this is how it happens. So these are the main participants, and you can think yourself, a market where government itself is involved, central banks are involved, commercial banks are involved, finance houses, big institutional investors like insurance companies who have a hell of amount of funds available to them. Then there are mutual fund investors. Then there are retail investors like you and me. You can just imagine how big the size of these market would be. So this is not something which I have written myself. You can simply Google it. I have just given you a highlight. Stock market is not a global market. Stock market is a country specific market. For example, Pakistan stock market, primarily you will find without exceptions that the investors are mainly Pakistan residents. Yes, some overseas investors are also allowed with certain terms and conditions. Similarly, New York Stock Exchange, you will find that the major significant investors are of America themselves. But yes, you will find some other investors as well who invest. So mostly stock market investments are of that particular country's resident itself. Overseas investors are not common. They are there as an exception, but they are not a significant part of stock market. Any stock market in the world, if it's a big country stock market, you will find that billions of dollars per annum it has its volume per annum. But commodities are much more expensive than stocks. For example, you can just think, how can you compare a company's share with a commodity like gold? You can think yourself, a market where gold is traded, where oil is traded, where silver is traded, and etc., etc. Obviously, because its amount is very high, therefore its volume is also very high. So according to Google, you can Google yourself, the commodity markets traded volume tends to be trillions of dollars every annum. But the number one, that is biggest market in the world is forex market, which is in quadrillions, not trillions. This is the biggest market. So the biggest financial market around the world is forex market. The second biggest is commodity market, and the third biggest is stock market, given its size and volume. And just to give you an example, one single cryptocurrency, one single Bitcoin, for example, in previous year 2021 saw a high of 67,000 US dollars for one Bitcoin, and that is only we are talking about one Bitcoin, whereas at this moment approximately between 11 to 12 million Bitcoins are in circulation. Not only that, you can just imagine how much British pound is available around the world, how much US dollar is available around the world. So this is far bigger than other markets. So these are the three markets with so much of volume, and because of its quantum, it has high regulations. Stock market tends to have the highest regulation. So number one regulations, highest focus of regulation of any country is on its stock market. For example, for New York Stock Exchange, you will find too much of regulations. For Pakistan Stock Exchange, you will find too much of regulations in that. So very highly regulated. Commodity markets is global. So you cannot restrict anyone to buy gold in Pakistan only and sell gold in Pakistan only. It's very much possible you buy gold in Pakistan, sell gold in any country you want, just fly to any country and just sell over there. It is a global market basically. So it is not possible for one country to regulated. So every country has its own regulation. For example, for commodities, Pakistan has its own regulation known as Pakistan Mercantile Exchange. Forex market, there are some countries with forex restrictions, but there are very few, uh, near to none. So every market has its foreign exchanges. For example, in Pakistan, you can find shops in which you can go and buy dollars, sell dollars. There are exchange dealers sitting over here. There are international forex brokers uh, available for you to trade online. So forex is global. Every forex is currencies are traded in every country. Yes, cryptos is an exception. Cryptos is legal in some countries and not allowed in some countries. But from apart from crypto, remaining currencies, USD, British pound, Chinese yuan, Japanese yen, anything, everything is tradable freely. Every country has its own regulations, and for example, for UK, it's FCA, that is Financial Conduct Authority, that regulate it. And for Pakistan, in fact, Pakistan Mercantile Exchange regulates it, in fact. And every country has its own forex regulation authority. The liquidity, speaking of liquidity, liquidity means how easily and how quickly you can sell an asset in the market. How quickly? In fact, all the markets are liquid, but the least liquid market is stock market. The reason being, it is very much possible that I go today in the working hours, for example, and try to sell my PSO shares, but I do not find a buyer for few minutes or few hours or maybe a day, or the prices are locked due to Pakistan stock market rules. So my shares will be sold, obviously, but not within a matter of seconds. Sometimes it is very liquid. You can sell in a matter of seconds. Sometimes it is illiquid. It takes some minutes, hours, or days to sell your asset. So it's not very highly liquid, but still liquid. So this is my term, that it is a medium liquidity. Commodity markets is very highly liquid. It's open for 24 hours a day, because at some places in the world, in some countries in the world, when it is night, it is day on the other side. For example, when it is off time in New York, it is the early hour opening hours in the New Zealand and Australia, followed by Japan. So the sun revolves, the earth revolves, and at any given point of time, there is morning in one place, in one country, whereas night in another country. And because it's a global market, so this can be sold anytime, 24 hours, but in the working days, that is 5 days a week. Forex market, obviously you have US dollars. Just tell me, I'm a ready purchaser already. So anyone is ready to purchase dollars in Pakistan, I hope. In fact, some people are suggesting that dollars should be sold when dollar is going to go down, because of Superman economist just arrived in Pakistan. Anyways, Forex is very highly liquid. Uh, in fact, both are very liquid, commodities and Forex, but with a slight difference. Forex is a little more liquid, in which you can sell your currency in a matter of milliseconds, literally milliseconds. That is so much fast. Whereas commodities is also seconds, 2 milliseconds. So these are very liquid markets. And this is the last for today, to sum up all these things, and I would like to take your questions after this. So to conclude, the research suggests, efficient market hypothesis suggests that there are three forms of efficiencies in the financial markets. Research suggests there is no strong form of efficiency. Strong form doesn't exist, that is only theoretical. Either it is weak form, that is random walk, or if information, news are considered, then it is semi-strong form. Research on efficient market hypothesis suggests that most of the countries' most of the stock markets in different countries exhibit weak form, because in most countries literacy is not of that level. But some countries like New York Stock Exchange, Tokyo Stock Exchange, London Stock Exchange, they do exhibit semi-strong form as well. So stock markets tend to be weak form to semi-strong form, but commodity markets and forex markets are researched to be semi-strong form, which means they do take into account each information which is released, that is all economic information is taken into account along with past price movements, suggesting random walk and movements according to the news releases. So this is the summary of today's session. So thank you, and this I'll be providing these slides to the ACC Pakistan, and this would be available to you all. Anyone who would like, they can just email and request the ACC office. I'm sure Mr. Feroz would facilitate you in this regard. I'll be emailing him, and it should be available to you. So love to hear relevant questions from your side. And thank you for joining. Hopefully the session was interactive and you were able to have some good insight into it.
Thank
Any
you, Richa.
questions?
Yes,
Yes.
I was about to announce that if you guys have any questions for Mr. Ray, please type in your questions, and if you or even if you want to unmute yourself and uh, ask him directly, that is also possible. I will be uploading this in a Google Drive of resources that we have already built and been using. I hope you guys are using that. Uh, the course material is being uploaded regularly after the events, after the webinar, sorry. So it will be uploaded as well. So do we have any questions or do we have any feedback? I do have already Mohammad Arslan Naseem's feedback. So I'm looking forward to more feedback from other participants as well. Mohammad Arslan saying is saying thank you for the revision. It was in some previous sessions about part of our ACC academic course. Yes, I can recall that as well. Aslan, thank you for highlighting. Okay, Aslan is saying very informative session. Okay, we have a question from Usman Mehmet. He wants to know where can we trade in commodities? Is this option available on CDC accounts?
Uh, the commodities can be traded here in Pakistan. There are few brokers regulated by Pakistan Mercantile Exchange. There are few brokers over here. And yes, on the CBC account, yes, you can trade commodities as well. But as I told you that most of the commodities traded are basically future contracts rather than allowing you a physical delivery. For example, you can't expect that trading commodities in financial markets and then later asking them for physical delivery of gold across border. So that is not going to happen. So it is future contracts. So commodities can be traded on futures.
Thank you,
So
Rachel.
hope.
We have some more feedback. Please type in your questions as well, guys. You don't want to miss this opportunity. Raisa have almost showed you some techniques and some tips on how to look at the news while you're trading. So we have another question. No, it's also feedback. Thanks, ACC Pakistan, for such a great session. A very informative and insightful session. Very informative session, excellently delivered. Mohammad Suleiman Samab is saying it was interesting. Not only got revised the efficient market hypothesis that I had studied in F9 and P4, but got new insights as well. That is correct. For me, it was quite informative, and I learned some new things as well.
Thank you for such a nice feedback. Thank you very much. So, would love to have any questions you have, anything.
Any other question from you guys, or should we wrap it up? I think that is our answer. So I hope you guys enjoyed the session. Looking forward to a similar attendance in the next two topics of technical and fundamental analysis. These will be some practical application of the concepts and the techniques which Reitza was talking about today. So anything that you would like to add as well, Reitza?
Thank you very much, all you great people, for joining me. It was a lovely session. In fact, your feedback is always an asset for me. The next sessions would be more practical rather than theoretical. Today's session was theoretical mostly. The practical aspects of real case studies of technical analysis of this today's world, the opportunities, how you can tap if any one of you finds interested in yourself regarding any of the financial markets. So I'll be giving you real practical and up-to-date analysis. And I'm sure this was something which to some extent most of you might be familiar from your F9 P4 studies. But regarding the technical analysis and fundamental analysis, though its scope comes within the ACCA studies, but the practical aspect is not exactly present over there. So that would be very unique. I believe that it is something that should not be missed. So I do look forward for attendance of all of you. And once again, thank you very much for joining. Looking forward to meet you on 3rd October again for technical analysis, and then the next session for fundamental analysis as well. So thank you. I would
Sorry for
like
holding
to.
you. Sorry for holding you, Reitza. We did receive two or three questions. Would you mind answering them?
Yes, please.
Okay, Amir Ramde is saying, in comparison to regional market as well as global market, Pakistani market has many limitations which are restricting potential investments. Any comment on this, please?
Actually, I told you that stock markets is stock market regulations vary country to country, and every country's perspective and dynamics differ a lot. For example, there is a 5% price difference cap in Pakistan, which is not prevalent in any other country I know, at least. So there is no such thing as 5% price cap. For example, if a market price is 100 rupees at the start of the day, for some reason, if the price moves suddenly to 105 or 95, that is 5% variation come, the stock market locks that particular asset and does not allow further trading. There are advantages and disadvantages for these sort of policies. The advantage is obviously that if today's day, which is a bad day, passes, perhaps tomorrow would be a new day, and the panic prevalent in the investors might diminish to some extent tomorrow. So the market might not crash as it is suddenly crashing. There is a lot of money of people involved in it, so the government itself does not want the people to lose money just because of panic. But these are the this is the advantage which I have just spoken, but at the same time there are disadvantages as well. So it means that you cannot make a higher profit in a liquid day, because after 5% there will be a cap on the same day. Similarly, Pakistani stock markets offer less trading on margins. That is, you have to invest fully, and you cannot trade on advances and futures, with few exceptions. There had been some experimentations, but as I told you, that the rationalism, at least what I believe, in Pakistani investors, due to less literacy in Pakistan, does not allow free sort of trading like other countries in Pakistan. So that is the answer to a brief answer to your question. So
Thank
stock
you.
markets.
There's a comment from Suleiman Samab. Basically, you have almost answered the question, but let me just read it up for you. What do you think that why is Pakistani financial market weak? Is it due to sludge? Sludge is basically financial costs of government regulations, which creates inefficiencies.
The not only Pakistan, but I would say in most of parts of the world, in fact, uh, it is not like that all the investors in the financial markets do earn a fortune. The reason is that the people just enter without proper training. So investing is a profession in itself. So like, for example, you are an accountant, so you have to go around 2-3 years of studies before you can be termed as a professional accountant. Then you need some experience. For example, ACCA requires a mandatory experience of 3 years. So after that, you will be a qualified professional for that, and you can expect to earn a good fortune out of this profession. So the same should have been the case for investing in financial markets as a profession. But what happens is that the information is so much scattered, and the trainings is not available to a professional level. And even if that is available, people mostly do not opt for that. They just simply want to jump in. So having said that, let's assume an investor from a non-accountancy background. Do you really think that a non-accountancy background really understands the difference between the equity and debt instruments and the gearing? What is the gearing problem? What is the liquidity problems? What is the dividend? Okay, dividend perhaps is an easy part. Dividend growth can be at least considered. So so this is all about rationalism. So what happens is that not only in Pakistan, in most part of the world, uh, people just simply jump without proper training and experience of it. If that is not the case, I'm sure the results would be different. The people after learning, for example, not every time, but off and on, seldomly, I do offer some training once or twice a year, mostly once a year at least, and that not more than that, because I cannot afford more time than that. And there are people who do join me, get their training, get their experience, get their insights, get their trainings, get their tips, get their after training tips, and they perform very well. But on the same side, if anyone is not considering the material which is being told to them, which is taught to them, and they try to experiment themselves in order to find some holy grail sort of thing, then obviously that experimentation will result in unwanted results. So lack of proper training available and lack is the main reason for this. It's not only about Pakistan.
Thank you, Raisa. We have two questions regarding some insider trading. Uh, Mohammed Ijaz is saying, as we know that insider trading is illegal or unethical, then where stands the insider information to be used for strong form of market? And I think Ijaz has repeated that question. Okay, it is both of the times it's Ijaz who is asking about insider trading, insider information. Sorry.
Uh, okay, now there is a basically one thing is insider information, the other thing is insider dealing. The illegal part is about insider dealing. A person who is in acquisition of some specialized confidential information is not legally allowed to profit himself because of that. So for example, if let me put it this way, Pakistani government, irrespective good or bad, they have the information of exactly how they are going to manipulate. If word manipulate is not okay, we can use word manage. How they are going to manage the exchange rate between USD and Pakistani rupees. What is their plan? They know, we don't know. Now this information is a sort of confidentiality, a sort of, and is available to very few people in the finance ministry of Pakistan and some big politicians. Now, if using this information, they make money out of this currency market, forex market, because they know what is going to happen in advance. They accordingly buy or sell the asset in accordance to what is going to happen because of the confidential information they have, that is termed as illegal. But the information itself is not illegal, the conduct is illegal. But there is no case as such in which you can, it is but I would say that it is more like a ethical illegal sort of thing than a criminal sort of activity. There have been very few exceptional cases, especially in the UK, in which uh, the penalties have been imposed because of insider dealing. But that is an exception. Those were exceptional cases. Even today, there is no reason to assume that the American government or UK government or Pakistani government does not make a fortune out of that. So let me conclude. Insider information itself is not illegal. Using the insider information to profit yourself at the expense of others is considered morally incorrect, ethically incorrect, and in some sense a sort of illegality. Now, talking about the strong form of efficiency. Now, what I have said is strong form of efficiency would be if that insider information is available to every investor in the market, which cannot be the possibility. How the hell is everyone is going to know what is going to be the dividends of the PSO in the coming months? How can everyone know? If I am an accountant of in a PSO, I know what is going on. So this information is inside information. Now I or my closed ones can benefit out of this, but I'm not going to make it public. Obviously, I don't want to get myself killed from the company's big officials. So that is not going to happen. So if I can make it publicly to each and every investor in the stock market, then the stock market is strong form. But as you can understand, that can never happen. So that is why there is no strong form efficiency in any financial market in the world. So there are few people who can take advantage, but all the investors cannot ration themselves based on this information. Hope you got the answer to your question.
For a detailed one as well. Thank you, Rachel, for your time, for all the information that you have shared with us. We'll be calling it a day and meeting again on 3rd October, Monday. And Mohammed Raz is saying, well explained. Thank you, Sher, for your for a comment for you.
Thank you very much for all the compliments and feedbacks. It was very nice. Thank you very much. I will also call the day off now. Wish you all a very blessed day ahead. Thank you very much.
Thank you. Have a good week ahead as well. See you guys on Monday. Bye bye. Allah Hafiz.
Allah Hafiz.